we're actually at a really interesting and, depending on how you look at it, incredibly exciting inflection point in economies and markets that should bring massive opportunities for people who are watching. What you should see from here is a gradual rebalancing of money from the US to the rest of the world until we get some kind of price equalization. I think the lessons that I would offer at the moment are that I think, can be nearly certain that the great bond bull of the last 40 years is over. You might also bear in mind that it's very, very possible for stock markets that have started very expensive to not make you any money for decades. As people begin to diversify, you all need to diversify those passive vehicles that you've been holding, the ones that are mostly invested in the US and have served you so well for the last decade, probably won't serve you very well anymore.
The whole Trump backdrop, I think you're right. Trump is partly a symptom rather than the cause of a lot of things, and we're seeing adjustments that would have happened anyway. But I think the markets, the consumer, will see just a kind of a backdrop which is not helpful, which seems to be anti-trade, anti-globalization, which seems to just introduce risk that we could really do without.
We're already seeing that, if we're focused on London, but the planning and infrastructure bill is changing the presumption in favour of development. Yeah. Power and low cost energy is absolutely critical to unlocking productivity, but also using development. We are positive about student housing in terms of, we think the government are committed to education as a sector. We're still number one globally ranked as best city in the world to study in. In terms of the office space, where your stranded assets, grey buildings, it's very much, if you're in the right location, people will invest if the floor plates are big enough.
Markets are as hard to read as I can remember. And, with the gilt prices staying, relatively robust, you've got to take an element of risk to make a material difference in what our investors can receive.
We want people to diversify, and we think we fit quite nicely into that sort of diversification of a portfolio.
I think everyone has been long US tech for a long time. We've always said that we don't want to compete with that because they're simply not the returns we're shooting for. We're very predictable. Some people would call real estate dull, but because you've had now the change in interest rate environment, we've got more clarity of where the yield curve is, and if we can achieve a premium to that relatively safely, it fits nicely into someone's portfolio alongside their equities and their gilts.
What do you think that the risks are of rates actually going higher?
I wouldn't expect them to go higher particularly, but nor do I expect them to come down much lower. I think we are reverting to a position that we should have probably reverted to about 6, 7, 8 years ago. Central banks should probably have corrected back to what now looks like a fairly normal historic rate of interest in a fairly kind of benign economic climate. So 3-4% interest rate is 15, 20 years ago that would be a good interest rate.